President Biden wants to get a $1.9 trillion stimulus passed through Congress, and the Federal Reserve Chairman Jerome Powell is itching to print up the currency to fund it. All eyes will be on the dollar in 2021, and we have you covered each month on the latest inflation trends. Let's get into it. Hello, my fellow YouTubers, and welcome to Papaya Cast, the channel where you get the information you need today to prepare for the economy of tomorrow. Today we're presenting our monthly outlook on inflation in the U.S. We'll go through the latest data, see what's changed since the last month, check for warning signs and risks, and talk about why this matters to you. Last week, the Bureau of Labor Statistics released a lot of data for December prices. All things considered, the latest data show that inflation remains pretty tame. The Consumer Price Index came in at 1.3% year-over-year growth, and the Producer Price Index came in at 0.8% growth. Nothing too crazy. We can see here that the prices have been trending higher from the lows hit back in April and May of 2020, but much of that has been recovery from a rebound in demand. Price growth is still well below where it was before the downturn. On the domestic front, everything looks good in the headline numbers. How about our finance indicators? The dollar has ticked up a bit in the recent data, but over the last year, the downward trend is quite clear. The stock market continues its upward march after fully recovering, with the S&P 500 up 14% from this same time last year. Gold and silver have done better than stocks over the last 12 months, but have been trending sideways for the most part over the last few months. And everyone's favorite questionable asset these days, Bitcoin, has left everyone in the dust. It's had a big pullback recently, and there are some things driving that. But we're going to leave that analysis until our next video on Bitcoin valuation. Looking at things from an international perspective, prices for U.S. exports and imports are showing a similar pattern, recovering from the downturn early last year and approaching previous growth levels. When you put the international trade and domestic prices together, we do see a bit of a difference here in some of the history. Import and export prices fell much further last April compared to domestic consumer and producer prices. Here's a big reason why. Trade prices are much more sensitive to changes in the value of the dollar. At the onset of the downturn, investors were buying dollars as a safe haven asset, pushing up the value. This hurts demand for our exports as they become more expensive in other countries. For imports, a stronger dollar allows us to buy more for less dollars, making the U.S. imported price in dollars lower even if the actual price of the good or service is the same in the foreign currency. So, in addition to a global downturn that sapped demand, there was also the double whammy of a stronger dollar. As the dollar has weakened and the economy rebounded, we've seen these international trade prices recovering as well.
Hey, I've been telling you guys in previous videos that watermelons are definitely better than papayas, and now I have proof. Mr. Papaya isn't the only one who can read numbers. Here's the price of papaya imports in the US, and here's the price of watermelon imports in the US. Watermelon prices are clearly more volatile, which is much better than those more stable papaya prices. The more volatility, the more risk, the higher the potential return. So, go ahead and give this video a thumbs up so we can get some more volatile analysis in here.
Now, I'm separating these prices into domestic and international categories because they are different ways we could see movement in inflation. Domestically, an increase in the money supply leading to more money chasing goods and services can drive up inflation. Internationally, if other countries are losing faith in our currency because we're printing our way to prosperity, that will affect exchange rates, which determines the value of the dollar. A weak dollar will send import prices up, which will then affect domestic prices and push inflation higher as well. So we need to always be aware of both sides of that coin. On the subject of domestic prices, the president of the Kansas City Federal Reserve, Esther George, made an interesting comment recently. She said that we might see a faster than expected rise in inflation as the economy recovers and sectors that were hard hit due to social distancing policies rebound. It's a decent theory, so we checked it out. We analyzed the price indices for personal consumption expenditures, or PCE, the Federal Reserve's preferred measure of inflation, and created some custom expenditure-weighted price indexes for sectors that have been hardest hit as a result of social distancing policies, and those that weren't hurt.
Okay, he's doing okay with this video, so let's make sure and give it a thumbs up and share it on social media so we can all stay in business.
In this graph here, we see overall inflation based on the PCE price index as of November coming in at 1.1% on a year-over-year basis. For sectors that have been hardest hit, the index comes in at negative 1.6%. And for sectors that have done fairly well over the last year, the index is up 2.5% over the same time period. So there could definitely be something to what Fed President George is saying. It's not a factor that's going to drive inflation into double digits at any time soon, but combine that with additional money printing to fund more government stimulus efforts, such as President Biden's proposed $1.9 trillion relief package, and expectations of higher inflation that are becoming more widespread. And then you have a recipe for a risky situation. We're not there yet. And that's why we're going to keep doing these monthly outlook videos to keep you up to date on the latest data and how it could affect you. Inflation hits us all. For the average American, an increase in the price of housing, food, or gasoline, for example, is going to take away funds that can't be spent elsewhere if wages aren't rising in pace with prices. For investors and savers, it forces you to put dollars into assets and commodities to preserve returns and future purchasing power. Where to put those dollars is a subject we'll be covering in an upcoming video on where to invest in times of high inflation. We're going to look at a wide range of asset classes and the advantages or disadvantages to each one as it relates to inflation. If you found this episode useful, please give it a thumbs up. And I hope you will consider subscribing to this channel. And don't forget to hit that notification bell so you'll know right away when our next inflation outlook or other video is released. If you didn't find it useful, go ahead and give it a thumbs down. And let us know in the comments section below that watermelons are definitely better than papayas, and that I should seriously consider getting a clinical examination for multiple personality disorder. Either way, I'll see you in the next video.